How to profit from Federal Reserve rate. Don't you wish you had known, just before the housing bubble burst, where to put your money to take advantage the mayhem that resulted when the bubble went poof? I do. I know people from it. This got me thinking, what's next? I hear a lot of smart people saying that interest rates are going to rise dramatically in the next 1 to 2 years, due to the massive amount of money that's been printed and the need to tame inflation that will result from it. Even without all the talk of printing money and inflation, with current Federal Reserve rates currently at 0 to 0.25%, it seems to be a pretty sure bet that they can only go in one direction, as I don't think quantitative easing will ever involve having countries pay for the privilege of lending the US money. So in my little brain, it seems that a long-term leveraged way to benefit from a rise in Federal Reserve rate would be a pretty safe investment. The only real risk is when they will go up, not if. Is there a flaw in my logic? Please chime in. And more importantly, if my logic is decent, what specific investments can be used to directly take advantage of a rise in Fed rates, preferably with leverage? Short treasuries. That is likely going to be a hugely profitable trade. But as you mentioned, the timing of a trade like that is critical. Who knows how long interest rates will stay this low? I doubt we will see an interest rate hike before next summer at the earliest. I don't think interest rates can go up anytime soon, so there are ways to ride this yield curve for a while. MBS REITs examples: WOC, NLY, CMO, ANH should go up in the rate environment. As the Fed starts hinting that interest rates are about to go up, then short these same stocks. I just finished selling all of my WOC today for just small profits. I might re-enter, but the paper this company holds bothers me. NLY, CMO and ANH hold mostly agency debt. 12-month yield now at lowest ever makes these stocks much more compelling. It's utopia for these companies now, and as long as Fed keeps pressure on the rates, there will be plenty of beautiful divvies. Your own DD. But let me know if I can help. I am very long all NLY, CMO and ANH. PST and TBT, they are Treasury short ETFs. I have been holding NLY and increasing my position for the past year. It is one of my top performers. I am sure the others are good too, but I try to keep a limit on my exposure to one industry. I have traded a lot of TBT in the past, but now I have a hard time understanding the short EFT since Treasury yields are basically lowest levels ever, yet the unit price of TBT is above its low point achieved in October. Can someone explain that? One would think at current yield levels, TBT would be hitting its all-time low price per unit. I don't know if shorting Treasuries at this time is the way to go. Swiss, Greece, Dubai all just this week alone announced upcoming defaults. British pound is experiencing mass exodus. Japan can barely keep its nose above water. The European banking system leverage is too much for the euro to handle. Most of the world currencies cannot handle the sheer volume of funds like the US dollar can, and despite the debt load USA has currently, their risk of default is surprisingly lower than just about everyone else in the world. What's left? BRIC. China keeps the yuan pegged to US dollar, Russia is too corrupt and unstable, not to mention hostile. Brazil, China and India have probably best futures, but their economies are fractions of the USA's. And even combined, these currencies would never be able to handle amount of funds looking for a home as the US Treasuries have provided. To take advantage of the current rate environment. This is probably one of the steepest yield curves in eons. Last time this yield curve steepened, the MBS REIT sector hit the mother lode. There used to be dozens of companies, but today there's really only a handful, and the best part? Much of their risk is reduced because their exposure is largely GSE, Fed-backed debt. It's nirvana. Can I ask you to explain this a bit more, specifically what it means to an retail investor like me? When talking yield curve, it is the comparison of a long note versus a short note. Historically speaking, the yield of the 2-year versus the 10-year is what most financial analysts or economists use to forecast economic activity. Almost every single recession was predetermined by an inverted yield curve. Typically long bonds have higher rates than shorter bonds. During inverted curves, the short yields are actually higher than long. Plot them on a graph, and there you have curves. Wide, steep, inverted, etc. Excellent overview about yield curve from an inverted yield curve occurs when long-term yields fall below short-term yields. Under unusual circumstances, long-term investors will settle for lower yields now if they think the economy will slow or even decline in the future. An inverted curve has indicated a worsening economic situation in the future 5 out of 6 times since 1970. The New York Federal Reserve regards it as a valuable forecasting tool in predicting recessions 2 to 6 quarters ahead. In addition to potentially signaling an economic decline, inverted yield curves also imply that the market believes inflation will remain low. This is because, even if there is a recession, a low bond yield will still be offset by low inflation. However, technical factors, such as or global economic or currency situations, may cause an increase in demand for bonds on the long end of the yield curve, causing long-term rates to fall. This was seen in 1998 during the failure when there was a slight inversion on part of the curve. The rationale behind this is if you had a lot of cash, example, 100 millimeters, and didn't have much faith in long-term prospects of US economy, would you put it into a 30-year or 10-year note? Maybe the 1-year or the 2-year makes more sense. Now we have an understanding of the yield curve. The way it applies to MBS REITs is these companies, which happen to be very complicated financial systems specializing in holding and trading instruments, simply use leverage to capitalize on the yield curve. This is the most simple way to view the companies. Now, the risk to the shareholders in the past has been the quality of the bonds and risk of default. In rare cases, the bondholders got screwed. But when the bondholders get screwed, that means all else has failed and the shit has really hit the fan. Creating zero value for shareholders. Today, the US government has set precedent by entirely backing those higher-yielding bonds issued by Fannie and Freddie and eliminating probably 99% of the risk. As a result, the longer instruments are minting money. The 3 months up to the 2-year notes are very low. Big demand drives down the yield, so the spread between the long and the short is huge. I don't know what they've been historically, but applying to basic calculation models that NLY, CMO, AGNC, ANH use shows these companies are making some serious coin. This is their sweet spot. As the rates change for whatever reasons, that will immediately impact those same companies' ability to make money. For those who haven't fallen asleep yet, when you buy a bond with a guaranteed fixed coupon payment, the yield is determined by how much you pay for the bond. Example, a $1,000 bond that pays $50 per year is a 5% yield. That same bond may be bought for $950 with a $50 payment, thus creating 5.3% yield. Now, a mortgage-backed security is nothing more than a pool of cash represented by mortgages that are wholly guaranteed by Freddie or Fannie. During the height of this financial crisis, Fannie or Freddie were considered taboo after they defaulted on their preferred stocks payments. So to generate confidence, the US government then guaranteed their interest payments on the bonds. Preferreds and bonds are two different classes, but PFDs have always enjoyed a prestige for safety. Well, no more with MBS REITs do not own real estate. They only own the paper that represents the liquidity in the re-markets. Sorry if this is so defragmented and spotty. I didn't thoroughly proofread and I am sure you'll have more questions. But on last note, The bond market IMO is a much stronger reflection of investor sentiments on the overall markets than all of equity markets. It's a much larger pool of cash, too. Keeping an eye on macroeconomic indicators, i.e. unemployment, dollar exchange, inflation or deflation, etc. is crucial to determining bond market movements, thus making it easier to forecast future MBS REIT share price movements. Thanks for an excellent explanation. Helps me start to understand how companies like NLY can pay a 15% dividend from buying 5% mortgages. Will take me a few more readings to really get it. Any resources you can recommend for understanding the macroeconomics to be able to do well with this type of investing? Just yesterday or today, Lloyd McAdams does a presentation for the company he chairs, ANH. It's a long presentation but really covers a lot of ground. Great primer. I didn't listen to all of it, but the snippets I got were informative. One thing I got was that ANH's leverage is about 5.5%, others are into the low double digits as far as leverage is concerned. This is the link. I also recommend reading Marilyn Cohen's The Bond Bible. Lastly, paying attention to Fed beige book announcements like this morning's give a strong indication of how the Fed perceives the economy and gives insight how likely the Fed will raise rates. It is essentially possible because of leverage. Let me give another simpler example to illustrate. You buy a house for $100,000 and put $20,000 down. The house is really worth $200,000, but you got a deal. You sell the house 1 year later for $180,000. So you used $20,000. Forget any payments, just assume no other costs for the purpose of the example, and sold for $80,000 more, netting you a $60,000 profit. By using the debt mortgage as leverage, you were able to earn a 300% profit in 1 year. This is a similar situation with companies like NLY. They can borrow at 0% and loan at 5%. They use debt leverage to increase returns. NLY is a REIT, so they must pay almost nearly all profits as dividends in order to avoid taxation, so you are also getting a dividend from pre-tax earnings. A couple of more things to elaborate. The short bond rates is a reflection of the banking system. Overnight rate is low currently, signifying that banks are happily keeping fluid. When this rate spiked as it did last year during height of financial crisis, we saw extremely high short note rates because banks all but hoarded the cash in fear. The long bond is a reflection of how the bond market sees the health of the overall economy. Currently, there's really no fear of systematic collapse, but there's still concern surrounding tax rates, unemployment, deficits and state liquidity problems, thus keeping money out of equities and keeping them in bond markets. So that's why watching Fed sentiment is important. As soon as long rates decline or short rates spike, the REITs start getting shot in the back of the building, from Jeffrey's NLY report early November. Appears liquidity is keeping leverage down for all of them REITs. This thread is getting a lot of views, so I thought it'd be appropriate to throw my thoughts out there. They're worth too, so you'll get your money's worth. Unemployment numbers today are viewed very favorable by equities early in the day, but methinks this blip is an aberration. Government unemployment calculations are tallied much differently today than just a decade ago. The double-edged sword for us mortgage-backed REIT holders is that they will start raising overnight rates as the economy begins to improve, thus impeding REITs' ability to make moolah on the spread. Big auctions to tune of 135 be going off this and next week. Vast majority of them are short notes. Undoubtedly a reflection of how much money is flowing into the bond markets, and this is just a theory, but as institutions keep hoarding cash via treasuries, then there is less for them to lend out, thus further drying up liquidity for loans. Who knows, it's just a thought. Looks like markets just changed sentiments and S&P is down now. If unemployment continues improvement in the next 60 days the way it did in today's announcement, then look out from the Fed with trigger fingers to start jacking up rates to help strengthen the dollar in hopes of paying off the debt faster. Probably not until after 1Q 2010, but nonetheless the writing will be on the wall. And this is important to anticipate to avoid a slaughter in the MBS market. Now would be a great time to tighten up your trailing losses on your MBS REITs like NLY. I have tightened my stops already. As Randall stated, once the news comes out that the Fed is raising rates, this will be a big hit to this sector. Because of their leverage, it will severely hit their bottom line, and the big investors know this. This sector is on eggshells right now and is being watched closely. As long as the Fed keeps rates low, it makes buckets of cash. Once the spread closes, not so much. As a side thought, the day or day after the Fed raises rates, as long as it is a small raise like 25 to 50 points, these MBS REITs will tank. This may be a good buying opportunity for the market leaders here. Although the spread will be smaller, the fickle investment community will likely punish them for the Fed news, and the dividend yields will probably be quite good. At the minimum, it's worth putting on your watch list. GW, look at rate charts from 2004. Fed jacked up their rates every meeting and drove it to 5.25% if memory serves correctly. At the end of the day, the news of the rate increases impacted the stock values a lot more than the actual rates did during the tightening period, and dividends were still being declared. Today's economic climate is much different than it was a few years back. The economy was really on fire and productivity was at unbelievable levels, which contrasts our scenario today. The tax burdens will be here to stay. Back in 2004, the big talk was how many taxes could be cut or eliminated. Unemployment was 5% using more conservative estimates versus today's 10%. Banks or lenders had a lot of liquidity versus today's very hoardish mentality. So, the Fed would be practically asking for a coup d'etat if they jacked up rates at the pace they did in 2004. Methinks they have certain levels of deflation, budget amounts, foreclosures, tax income and unemployment among others that triggers Bernanke to raise rates. The other side of the argument is that Bernanke is content with stabilization, and a prolonged period of the new normal is justified to jack up rates even if unemployment stays at 10%. But my crystal ball says we're a long ways economically from that point. Still very, very long. NLY, AGNC, CMO, ANH. I also have a small WATSIM which I didn't mention before, but it's not agency debt. Wish I had more. That's been a mighty fine performer. Do your DD. Very interesting to look at the manipulation of the Fed funds rate. It is a direct correlation to the consumer savings rate. You can clearly see how the decrease in the interest rates caused a decrease in consumer saving, which of course caused the increase in a debt-fueled spending spree in housing and all consumables. This couldn't paint a more clear picture of how government intervention was the primary cause of the housing bubble and subsequent economic crisis. And now our policymakers think more regulation is the answer to the problem. Savings rate down all the while the consumer debt is decreasing. You can bet your bottom dollar the low rate is deflating, no pun intended. BTW, the 28-day UST went off today at 0%. That's right. No rate of return when you buy UST bills these days. Can you explain to me who would be buying this debt? And even more puzzling to me is why? I love this thread. BTW, coffee. If you have $50,000 to save, you put it in a savings or money market account. But if you have $50 billion, your local Bank of America is not a good choice because you are only protected by FDIC up to $250,000. Obviously an individual doesn't have $50 billion. But governments and large companies around the world do have billions in cash and need to put it somewhere in order to keep it safe and hopefully get some kind of return. Right now you or I would be crazy to buy treasury notes, but countries like India and China, which have budget surpluses, must do something with that money, so they park it in US treasuries. That is shifting toward other assets though, like gold, silver, and other currencies. Think about it. You have 50mm bucks. You don't want to invest in new biz. You don't want to lend it to your brother. You don't want to buy stocks in this unstable environment. You just don't need this money to grow. You just need it to be safe and sound. You want to sleep without worrying a peep about it. Open the BAC money market? What if it fails again? US government will probably take different steps this time around, so where can you really put it today without any risk whatsoever? Only in America, baby. The most ironclad system in the world to protect money even if the world enters World War III or another Great Depression. I had just last year moved some money from one institution to another fearing it was going to fail. I also moved money from a trade within past year after rumors came around of its failure. Granted, these dollars were protected by government, but I didn't want it tied up. There are basically no other options to put cash without any risk of default. It's really an amazing concept. I hear what you guys are saying, and in a way it makes sense. But, allow me to play devil's advocate, with a 30 bill yielding a massive 0% even if we take the government's own, highly suspect inflation of 4%, in reality it is greater than 10%. That means that my real rate of return is -4%. By end of year 30, when I cash out my bond, my $50 is going to be worth $14,692,882.16. If we take 10% inflation, it will be $2 now for me. If I'm going to blow $35, I can think of many ways that are a lot more fun than handing it over to the Treasury and watching it evaporate for 30 years. My conclusion is that a 30 bill equals better off keeping the cash for fuel for the fire, or throwing the party of a lifetime for everyone I know. What am I missing? For starters, the zero-rate bond that was auctioned off this week was a 28-day T-bill, not 30 years. The 30-year notes are running at 4.375%, which running at government-stated inflation rate. So what are you missing? The fact that big money felt secure last October while their cash and investments were sitting with Bear Stearns and Lehman and went kaput. The same sovereignties, institutions and private groups who all either felt that sting or knew of others who felt that sting have still been holding tight and cannot trust anyone. When people are against the wall of fear and scramble to place large cash deposits, under the mattress doesn't count. There's really no other single place on this planet that is as secure as the US Treasury. The main thing you are missing is scope. You are still living within your small world as far as this example is concerned. As I stated, if you have $50,000 or even $50 million, treasuries may not be your best option. But if you have $50 billion, it is likely your only or one of a very few option. When India has $50 billion, is it realistic to think their central bank will keep it in cash? Or a Bank of America money market account? Or speculate in the stock market? Not likely. They have different objectives than you or I, and they have a much different scope of investment. Some of my largest holdings all announced dividends this week. NLY, CMO, MFA, ANH. All that 15% plus divvy at today's prices. But running 20% plus on purchase price. Not exactly fast lane, but a lot of risk is eliminated by understanding how this sector works. Spreads are still historically low, but as long as Fed stays real low, we're good to go. Keep an eye on that unemployment data. To me, that's the biggest indicator that prompts the Fed to raise rates. Most of these don't go ex-diff for a few weeks yet. Do your own DD. Regards. This is the conclusion of a Barclays mortgage-backed security report I read this morning, but the last line below that I bolded and enlarged confirms what I've been consistently pounding the table on. Gladly someone making a few $100K per year agrees with me, right? Based upon back-of-the-napkin analysis, the stocks mentioned in previous posts will probably trade at 25% yield based on today's pricing, or the share price will drive the yield lower. If you want the report too large to attach, you can send me your email via PM. It's not for public circulation, so you want to profit from Fed rates. Play the spread via MBS REITs. The riskier non-agency REITs will have higher returns. Sim. WASI am seeking at an 18-month 50% to 100% return. Copied and pasted from the report. Sent it a few minutes ago. Let me know if you didn't get it. Post the questions here. I rarely check that email, so don't respond there. Quite frankly, of all of the MBS reports I've seen in the past year, this Barclay report is far superior versus Jefferies, ML, RBC among others. Thanks, I got it. Looks like a good report, but I don't think there is enough background info for a novice to these types of investments. Looks like they are assuming a high level of understanding already. It actually seems like this is a set of slides to a presentation. Is that correct, or do they assume that the reader knows enough to fill in the gaps? I'll dive into it more in the next couple days and let you know if I have any other questions. Thanks again. John. The most important points are pretty basic and many times highlighted in newspapers anyway, but presented in concise fashion on this presentation. I concluded from this report that MSRITS is a very good place to put money now, thankfully, since I've been invested for a good part of 2009. The spreads are widening and the government is basically backing the entire MBS agency REIT sector versus the banking sector, which the FDIC is busy shutting down on a weekly basis. See page 38. So, this sector is safer than banks. Also from this report, we can get a pulse of the housing market by following this sector. The wide spreads tells us we are absolutely not out of the woods foreclosures and OREOs, but the harshest impact has been felt already. Just my observation. Lastly and ultimately, all of the new paper hitting the market is much healthier using stricter metrics, i.e. income, debt ratio, FICO, thus reducing even more risk. BTW, SIM just announced 0.17 dividend, which is approx 17% yield based on WED's price now. It's about 15% yield, but keep in mind, SIM is not exclusively treasury-backed paper, thus higher risk. This sector is really in a big-time sweet spot. I just remembered one of the main and most important elements of the report. Demand for USTs is actually diminishing all the while short rates are still staying low. Read, spreads widening, which is a beautiful thing for MBSRITs. I am not advocating anyone to invest in this sector, as there are risks associated with them as with any stock, so it's important to DODD. Merry Christmas, Happy Chanukah, be safe, nice night to be with friends, and looking forward to tomorrow's spending with 20 family members. Update, I sold all of my MREITs and AMREITs on Thursday except for NLY. If I wade back in, I will pursue the non-agency REITs and go FAIRWalk, SIM among a couple of others. There's now government talk about not backing GSE bonds anymore, which makes the non-air REITs a lot more attractive based on risk or reward. JMHO. I thought it would be fair to disclose what my sells have been, and I'll post more in my shared portfolio thread. Bump, surprised there only seems to be a few involved in this convo. Lots of great info. From my part, it is simply too technical, so nothing to add here. Maybe many others have the same issue or lack the millions to make a profit from the current situation. I hear you. It has been a struggle for me to understand the info that Randall is presenting, but I've enjoyed reading along. If you go to NLY's website, there is an investor fact sheet link on the first page. It presents a simplified explanation of what they are doing. Even though I am beginning to get it, I still haven't bought any shares. One of my new rules of investing is to invest only in things I understand, and I can't, without lying to myself, say that I get it enough to lay my money on the line, despite that succulent yield. So for me, since I asked the question how to profit from Federal Reserve rate, I backordered and won a domain name, which I think is a killer domain with the risk of inflation just around the corner. It could become a very popular topic. There is always a way if you ask the right how can I? Question. I think one of the main reasons many people have ignored this thread is stock market investing is viewed by many as either magical or gambling, which it is neither. Many people on this forum are dyed-in-the-wool reinvestors or small business owners, or aspiring to one of those categories. I have personally been down those roads as well. When I ran my last company, I sold it in mid-08. I rarely had time to think about my personal investments outside of my company. In reality, I had very little personal investments outside of the company except some I feel my many years of running my own company along with analyzing deals has helped me tremendously in my stock market investments. I gave up on reinvesting because I have chosen a mobile lifestyle and just travel too much by design to stay on top of tenants. The beauty of technology allows you to manage your stock market investments from anywhere in the world as long as you don't mind odd hours. When running my last company, I realized I was so focused on the company, I neglected other aspects of my life. As strange as it may sound, I was neglecting my personal finances. I was living for the company and everything went into the company. All my time and all my money. When I loved the business, that was okay. When I started to hate it, I realized it was time for a change. Too many entrepreneurs get into that rut. We talk about regular employees getting caught in that rut, but entrepreneurs are even worse. They work harder and longer and can't quit their job to find a new one when they get tired of it. I know this seems off topic, but my point is, as an entrepreneur, you owe it to yourself to take the time to learn about investments like MBS REITs. You need to diversify your wealth beyond your business or your e-portfolio, and you don't need to have an overpaid, uninterested mutual fund manager making your decisions for you. Education is the key here. Not necessarily formal education, but educating yourself in investments beyond your current area of expertise. Personally, I intend to learn how to trade Forex this year as I don't know much about it. But I don't intend to dive in head first without the knowledge. The MBS REITs are really quite simple. They borrow money at a low rate and loan it at a higher rate. They use leverage to maximize the gains. In this environment, they are absolute money printing machines, hence the high yields. I started buying NLY in mid-08 at around $11 to $12 a share and have added to my position with an average cost of about $14 a share. I have also enrolled in the company's DRIP. Overall, I am up nearly 40% in asset value plus dividends. I have also taken a position in MFA. These types of investments have been really good to me over the past year, but I don't know if now is the time to get into them. At some point Bernanke is going to have to raise interest rates, and when that happens, that will cut into these companies' margins. I personally am not buying any more and have tightened up my trailing stops to 15%. I intend to ride it out now. I have closed out of almost all of my speculations for '09 as I think we have hit a top or at least flattened out. There doesn't seem to be much upside in many companies out there. My investments now are mostly big blue chips like MCD, WMT, VZ, PM, etc. plus a few others. I have also been selling puts on ETFs like GLD and SLV and other commodity companies like FCX. The Fed has only dispatched about 30% of TARP funds, so we will see another huge amount of government capital thrust upon us. Most of this money ends up in the stock market. While I don't agree with this politically, I intend to profit from it. Follow the trends and invest where the government is investing. I have also invested in a couple of geothermal power producers and will invest in some natty gas power producers. VZ was another government infrastructure play. There is a push for broadband wireless and VZ is the big dog. Watch the macroeconomic conditions and play trends. Keep tight trailing loss stops. Global, great post and nice job. I am in the equities bull camp now. But that's what makes markets. Speed plus true. This is a great arena to be in. A little knowledge of bonds and the mechanisms of the secondary mortgage market is pretty much mostly what's needed to invest in this sector. It's not for the feeble-minded, but this is probably the most practical way to profit from the Federal Reserve rate fluctuations or lack thereof. That's the thing. And VIF. Like any other stock, you can buy as little as one single share. The last time the spreads were wide as they're today was around 2002-04. And some of the money I made was unreal. And easy, but patience is needed. This is not a get-rich scheme where you buy the stock today and wake up tomorrow in a Lambo. But, you will see nice capital growth and income as long as the Fed rate is low. Yesterday's LIBOR was lowest in 25 years. The mortgage backs are printing money unlike anyone else in this economic environment except China. Maybe these essentially become large income vehicles which at this time are virtually guaranteed by the US government. This is really unprecedented. Agency MBS REITs only. The markets seem to be hungrier for more growth, and the non-agency REITs are providing higher yields, but of course higher risks. John, apologies for not presenting the info as clearly as I wished, but a few readings about bonds and mortgage markets will get you up to speed. And you are absolutely correct by not buying something you don't understand. That's a very important rule in investing. Many people unfortunately buy stocks because there are blogs and message boards touting it despite only knowing its ticker. But you know better. All of the companies I've mentioned have presentations on their sites like NLY. And the audio I posted from McAdam's ANH CEO is also an excellent primer. Speed on posting. Nice job on the acquisition. How can I be a contributor? That would be cool. I'm kind of in vacation mode for the next couple months, but my plan was to do something like an ebook guide to inflation investing, principles for various levels of aggressiveness. Then add a monthly subscription newsletter with 2 or 3 stocks, ETFs, etc. ideas a month. Have you ever thought of being an investment newsletter writer? Any chance you'd make it to the B&P meetup in Scottsdale next month? Would be great to meet you and you too. Global Wealth. Looks like the meetings need a few more paper assets, guys. I personally write a weekly newsletter. I won't however make the B&P 10. I live outside of the US and have a fairly busy travel schedule elsewhere for the next couple of months. I have thought of writing newsletters in the past but never pursued. And there's no time better than now, right? I am now very interested and ideas are swirling. Sorry we won't be making it to the B&P. A little family trip to Florida overlaps, and also I am moving my family into a new home in March, so there's much to do on our end here. Hey, you're not related to, are you? I subscribe to several of his letters. No relation, but I do share many of his views. I get his free newsletter, Conversations with Casey. 2 years to 10 years at very steep curve. Probably at historic levels. Would be nice to cash in this market knowing what we know, but quantitative easing is ending, so there is lots of volatility in MBS market. My advice would be to buy low, sell high. I started shorting treasuries last week. Didn't want to start a new thread, but Bobby shorted treasuries. Don't know if your position is still open or not. And the Fed rate is unwavering for the foreseeable future. I really think the next big deal is the muni market. There's a lot of panic that's driving this market down, and in all fairness, default rate is very low, so the risk for my strategy is low. Riskier than normal, but still low, in my opinion. Muni's gonna take a dump. And now, Mr. Ross has a very nice way to make money off this. This is a huge market, and this scenario will require patience for it to play out. At this time I am determining if I want to put 25% of my portfolio to this strategy of buying the distressed, high-rate munis. I'll let you know how it progresses. My short position is still open. It's pretty flat right now, but I feel this is a low-risk trade with very little downside. I mean, can they actually reduce interest rates? My tipping point was when Geithner announced that it was impossible for the US debt to ever be downgraded. Now it is only a matter of time. With my short position, I am out no cash other than any small mark-to-market adjustments that may happen, but I am waiting to catch this wave. I agree there is a buying opportunity coming soon in munis. Wait until CA or ME default, then buy TX munis. CA and ME will drag them all down, but TX will be okay. Maybe just buy a fund to spread their love. If you're so inclined, could you explain how you have accomplished this? What securities you are using? Stocks, bonds, options, etc.? Thanks. I sold short TLT. Frequently I use options, but not this time because of government influence in the markets. You can't tell when the ball is going to drop, and I don't want to worry about the loss of time value in options. Short selling is easier anyway. Thanks. I've always avoided shorting stocks that pay a dividend since I didn't want to have to eat the yield every month. I guess you just factor that into the risk or reward for the trade. I suppose you just have to factor that into your cost when figuring your risk or reward. For me, shorting TLT was a low-risk trade. But like any other trade, there is potential for loss. I just think that the downside is very low here, but the upside is 50% or greater.